dear hearers, I would like to represent your course with the name Risk Analysis and Monitoring of Corporate Investment Projects. I made this course. Well, I made it, as far as I think, very close to practical needs, so it is practical oriented course. And however, of course, as a beginning of the course, I would like to propose a brief introduction in some theoretical methods, but that is not the main goal. The main goal is to discuss how it may be applied in a real investment project or to assess real risks. So, first of all, I would like to tell you that in this course we will not discuss very sophisticated methods. All the methods that we will discuss you may find in PPM book materials, CFA, the first and second level, SSA, F9, and maybe another maybe another concerned materials, applicable materials. So first, I would like to tell you that this course is practically oriented, and I would like to confine myself in the limits of comparatively simple theoretical models, not very sophisticated. Sorry. Well, first point of my short presentation, of course this is just a very short presentation, is don't look on the risk through pink binoculars, because if you use some maybe sophisticated methods, you may look to the risk through pink binoculars. So you may underestimate risks, or maybe you may estimate it wrongly. You may think that you know everything about risk, but actually you don't, because risk is something that unknown, certainly. And of course, the risk is objective by its nature, but it is subjective by the way how we assess it. So you may read the slide on yourself, and here I just explain that we will confine ourselves in the simple methods, and this course is practically oriented. Sorry. This is CPM. This is the most applicable, the most common model to assess some kind of risks, particularly systematic risk, which is reflected in beta coefficient. But as I wrote in the title of this slide, CPM is good horse, but the pity it is short on legs. So I would not express you the main ideas of CPM. Maybe I will do it in the course, but now just demonstrate you some very short slides. But that is not, of course, the main goal of my course. As I told you, the theoretical ideas are presented only if they are necessary for practical application. So, traditional methods of systematic analysis and individual systematic analysis systematic and individual risks are: first, systematic risk is a risk that you cannot diversify. So that is first idea. In accordance with CPM capital asset pricing model, they describe it by beta factor, which reflects the sensitivity of the project, enterprise, or etc. To the global market risk. Actually, project, if risk of the project is estimated as standalone, not in the portfolio of investment projects, but as standalone as itself, actually it is equal to the risk of enterprise, of new enterprise that you create somewhere, somehow. So, but here's mathematical expressions. I will not read it to you, but I just mind that in the formula below, usually for practical use, we use not riskless rate, but rate of actually credits debt of the company. So the debt of the company, that loans of the company, that company may get from the bank. So why? Because actual risk, using a riskless rate would be theoretically right, but in practice that is wrong. To some extent, price of corporate debt reflects the cost of bankruptcy or maybe financial distress. Don't use either a raw beta nor theoretical market risk premium. Why we shall not use a theoretical market risk premium? Because theoretical market risk premium, theoretically, it is expected premium for the risks in the future. In practice, it is assessed on the very long historical data during 40 years, maybe 50 years. And it is very well known that, for example, for United States, it is about 4.8%. For Europe, it may be higher. And for some other countries, it may be higher. I will not represent you the table of market risk premium for different countries. And again, theoretically, market risk premium should be the same, because an investor can diversify his investments globally. Using instruments from all the world, including China's, American, European bonds and shares, whatever. So the classical formula for CPM, my point is the classical formula for CPM is rather theoretical than practical. When we use it in practice, we modify it. And theoreticians, academicians actually express negative opinion about this, because theoretically they should not be modified. They should be taken as it is. Okay, let's go further. Sorry, there's another. Scenario analysis. Scenario analysis is usually also despised by theoreticians because it's subjective, but actually in practice, usually we don't have any other options but to use it. And of course, to use it, we have to know how to do it, how to use it. And in Basel III recommendations, there are some ideas how we can provide scenario analysis on the data that we have. So we shall set out a similar situation with the same industry sector and at the same stage of the business cycle. It's also very important, because it's a different stage of business cycle, recession, stagnation, or maybe agitating, there will be very different statistics, and the sample statistics should be relevant to the situation that we explore today. Okay, so let's go next slide. We do believe in sensitive analysis. Yes, sensitive analysis is very good. It's very good actually. It's a very good tool. And at the bottom of the slide, I depict some useful expression for sensitive analysis for parameter P, for example, which may be price, for example. Well, and I believe that that is a good tool. It's a practical tool, and we often use it. Sorry. We don't recommend Black-Scholes method for real options. Why? Theoretically, it is widely accepted, but actually, if we take a deeper look, dig under the surface of this method, we'll see that it is based on some unrealistic assumptions. I will not mind it. That's now. I will do it in the course. But here I just tell you that when dealers in stock market use Black-Scholes method to price options, they use not real volatility, which is very key parameter of this method, but they use made-up volatility, which is so-called implied volatility, and it is not real volatility. And for real options, you will not have this volatility, and so this method probably shall not be used. However, some people use it, but I think it is not reliable. Sorry. Hedging systematic risk. And the last part of my introduction is about hedging systematic risk. Don't miss it with systemic risk, please. it is different type of risks, of course. To hedge systematic risk, for example, country risk, commodity risk, and some individual, country risk, commodity risk are individual risks. To hedge systematic risk, we usually shall use some global options on global indexes, or maybe futures on global indexes. To hedge country risk, we may use futures or options on country index. And of course, it is very sensitive balance which risk one have to hedge or avoid, because if you hedge all the risk, you will get no profit. So this is the end of my presentation, and this is the last slide, you see. Thank you very much. Goodbye.